welcome to This Explainer. Today, we're putting Airbnb's Q1 2026 earnings through the absolute ultimate financial gauntlet. We're going to see if the stock is genuinely a buy at $149 a share right now. We'll strip away all the market noise and examine this company exactly how the greatest investing legends of our time would.
Now, you might be wondering, Airbnb recently popped on those Q1 earnings, delivering some pretty flashy headline numbers. But wait, with macro headwinds blowing in and a super confusing one-time tax charge muddying the bottom line, we really have to ask, is this stock just a classic value trap or is it a massive long-term compounding engine? We need to hunt down its true intrinsic value.
So here's our game plan to figure that out. First, a quick company snapshot. Second, we'll look through the Buffett lens. Third, the Lynch lens. Fourth, the Graham lens. Fifth, we run the DCF and alternative models. And finally, number 6, we'll synthesize it all for our final verdict. All right, let's kick things off with Section 1, the company snapshot. Sitting at roughly $149 a share, Airbnb actually beat its Q1 revenue guidance, pulling in $2.7 billion. That's a super solid 18% year-over-year jump, mostly driven by incredibly robust demand and a 19% bump in gross booking value, hitting nearly $30 billion. I mean, they booked over 156 million nights and experiences. So by all traditional growth metrics, that top line is literally firing on all cylinders. But hey, the real story here? It's the cash. You know, Airbnb's capital-light business model generated a whopping $1.7 billion in free cash flow just in this first quarter alone. That brings their trailing 12 months free cash flow to a staggering $4.5 billion, which translates to a 36% margin. Simply put, that is an absolute mountain of cash generation.
Okay, moving right along to Section 2, the Warren Buffett lens.
Now, we all know Buffett famously hunts for a wide economic moat. And honestly, Airbnb clearly has one, thanks to its massive two-sided network effects and pure brand power. They're also pushing the envelope with features like Reserve Now, Pay Later, which already drove 20% of global gross booking value in Q1. But it's not all sunshine. They do face looming risks. Management actually called out a roughly 100 basis point headwind in Q2 nights booked, specifically tied to geopolitical conflicts in the Middle East. When it comes to Buffett's holy grail owner earnings, we can basically proxy that using their massive $4.5 billion in trailing 12-month free cash flow. Buffett loves consistent earnings, right? And this level of cash generation proves Airbnb isn't just some flashy revenue growth story, it is a highly profitable cash-printing engine. Of course, Buffett also demands manageable debt and honest management. Airbnb did just float a $2.5 billion senior unsecured debt offering. But when you stock that up against their fortress-like $16.75 billion in cash and restricted cash, that debt is basically a rounding error. Plus, management just raised their full-year EBITDA margin guidance to at least 35%. So does it pass Buffett's quality test? For sure, assuming we can snag it with a decent margin of safety, which would likely trigger a buy for him right around $130 a share. Let's shift gears to Section 3, the Peter Lynch lens. Lynch would probably peg Airbnb as a fast grower that's smoothly transitioning into a stalwart. They've got that fortress balance sheet we just talked about. But here is the kicker for Lynch. He wants to see insider confidence. And boy, do we see that here. Airbnb executed $1.1 billion in share repurchases in Q1 alone. Talk about management eating their own cooking. To actually value the stock, Lynch leans heavily on the PEG ratio. Just as a quick refresher, that's price to earnings divided by the expected earnings growth rate. He wants to make sure we're actually getting all that exciting growth at a reasonable price, ideally looking for a PEG of 1 or even less. So let's see how those numbers stack up.
Well, in Q1, a bizarre one-time tax charge seriously muted their EPS down to just 26 cents. But if we pull up analyst models from Ticker, as that tax drag rolls off, normalized EPS growth is projected to absolutely explode from single digits right now to past 50% by early 2027. If you divide a forward PE of roughly 35 by that 50% growth rate, you get a PEG ratio well under 1. For a Lynch-style investor, that makes it a screaming buy around $170.
All right, moving on to Section 4. Time for the Benjamin Graham lens. So running Airbnb through Graham's notoriously strict defensive investor checklist gives us a bit of a mixed bag. They easily pass on adequate size, strong financial condition, and earning stability.
but they totally fail on having a long dividend record because they prefer buybacks, and they absolutely fail on having moderate price to earnings and price to book ratios. Honestly, this is super typical for modern tech stocks, but Graham was a stickler, and modern tech usually gives his old school models a huge headache.
Let's actually run the math on Graham's famous intrinsic value formula, the square root of 22.5 times earnings per share times book value per share. When we plug Airbnb's numbers into this, we hit a massive structural wall. See, because Airbnb is an incredibly asset-light tech platform, it obviously doesn't own the millions of homes listed on its site. Because of that, its book value per share is artificially super low compared to your classic industrial company. With an EPS near $4 and a book value per share sitting under 15, Graham's math spits out a target around $35 to $40. That is literally miles below the current $149. Graham would demand a massive margin of safety here and would undoubtedly take a hard pass.
Let's dive into Section 5, DCF and Alternative Models.
Now, a discounted cash flow, or DCF, relies on four main steps: forecasting their future free cash flows, calculating a terminal value based on perpetual growth, discounting all of that cash back to today's present value, and finally, running a sensitivity analysis to stress test our assumptions. Let's look at what the math tells us.
Assuming an industry average weighted average cost of capital, or WACC, of 9.5%, alongside a pretty conservative 3% terminal growth rate, our base case fair value lands right around $180 a share. Even if we get really pessimistic and bump the WACC to 10.5%, we still arrive at a fair value near $145. So this definitely shows a modest to solid upside from today's $149 price tag.
And, if we look at alternative, forward-looking models, the picture gets even brighter. Ticker's mid-case model targets a massive $324 by December 2030. That implies a 118% return. This is largely driven by management raising that EBITDA margin floor to 35%, plus their strategic move to simplify the platform to a single fee take rate. Essentially standardizing fees so hosts absorb them, simplifies pricing for guests, drives up conversion rates, and should seriously boost long-term monetization.
Which brings us to Section 6, Synthesis and Final Verdict.
Bringing the whole shebang together, we're looking at a pretty massive divide. Wall Street consensus is playing it totally safe at 157. Benjamin Graham absolutely hates it due to the low book value. Buffett wants a slightly wider margin of safety, waiting for a pullback around 130. But Peter Lynch and those long-term DCF and ticker models, they see a highly profitable compounding engine that's just temporarily masking its true earnings power behind a one-time tax charge.
So our final blended verdict at $149 is a strong hold or even a strategic accumulate if you're a long-term investor looking for a powerful compounder. The underlying business is generating incredible cash. But honestly, it leaves us with a much deeper question. If the greatest value investor of all time, Ben Graham, would pass on a free cash flow machine like Airbnb, is traditional value investing just dead in the age of asset-light tech? Let me know what you think. Do you agree with the gurus? Please make sure to subscribe, like, and share this explainer to support the channel. Thanks so much for watching, and I'll see you next time.